Everyone thinks gap insurance protects your car. It doesn't. Gap insurance is widely presented as a safety net. You finance a vehicle, you drive it off the lot. If it's totaled in an accident, gap insurance covers the difference between what your standard auto insurance pays and what you still owe the lender. That's the accepted story, and it's accurate as far as it goes. But the reason gap insurance exists at all reveals something darker about how vehicle financing actually works. Here's the mechanism. You buy a $30,000 car with a 5-year loan. Day one, that car depreciates, not gradually, immediately. Industry data suggests new vehicles lose 10 to 15% of their value the moment they leave the dealership lot. By the end of year one, you've lost roughly 20% more. You owe $26,000 on the loan. The car's market value is roughly $21,000. That gap, that $5,000 spread, is the problem gap insurance solves. Standard auto insurance is contractually obligated to pay the car's actual cash value at the moment of total loss. Not the purchase price, not what you owe, the market value. Insurance companies employ adjusters and reference databases to establish that figure. If your $30,000 car is worth $21,000 when it's totaled, that's what the insurer pays. Your lender still owns the vehicle title until the loan is satisfied. You're responsible for the $5,000 difference. Gap insurance emerged as a financial product in the 1980s when longer loan terms and larger down payments became common. Banks realized they had exposure. If borrowers walked away from underwater loans, lenders absorbed losses. Gap insurance transferred that risk to the borrower, who paid a flat fee, typically $500 to $1,500, to protect themselves. The product isn't a consumer protection. It's a lender protection that consumers finance. The real question isn't whether gap insurance works. It does. The question is whether the depreciation curve it protects against is inevitable or engineered. Manufacturers and dealers benefit enormously from rapid depreciation. It ensures the used market doesn't cannibalize new car sales. It keeps trade-in values low, which increases the financing gap on the next purchase. Gap insurance is a symptom, not a solution. Lease agreements typically include gap coverage built in because lessees don't own the vehicle and the lessor controls the residual value assumption. Buyers, by contrast, bear the depreciation risk. Gap insurance doesn't eliminate that risk. It simply makes the lender whole if the worst occurs. You're paying to protect someone else's balance sheet. Understanding gap insurance means understanding why it exists, because the financing system itself creates a structural gap between what you owe and what the car is worth. Gap insurance doesn't fix that system, it profits from it. The product works exactly as designed. The design is what warrants scrutiny. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to keep uncovering how consumer products mask the systems they protect. This video is for educational and informational purposes only and is not financial advice. Always do your own research.